It appears I had an unmute problem. I'll try that again. Hello, everyone, and thank you for joining us at today's webinar, where we'll be discussing property insights and the economic outlook. My name's Donna Koshek, and I am the Professional Services Banking Executive for Queensland, the NAB. And as we begin today, I'd like to acknowledge that we're meeting across the lands of the Aboriginal and Torres Strait Islander peoples. I'm calling in from Meanjin, also known as Brisbane, on the lands of the Yagara and Turrbal people. Mark and Gareth are joining us from Melbourne today, the lands of the Kulin Nation, including the Wurundjeri and Bunurong people. And I acknowledge and pay respects to elders past, present and future, as well as any Indigenous customers or colleagues who join us today. Our two speakers are Mark Browning and Gareth Spence. A little about them. Mark Browning is our Head of Valuations and Property Advisory at NAB. His responsibilities include residential, commercial and rural valuations, as well as business valuations, panel management, operations and valuation risk and reliability. Gareth Spence is a senior economist at NAB. Gareth joined NAB after 10 years with the RBA and provides detailed analysis of the Australian economy and advice on economic developments to NAB, our customers and our network. We're thrilled to be able to share these insights with you today. And as Australia's largest business lender, we hope you'll find it useful in thinking about future opportunities for you and your business. In our session today, our experts will be discussing the general outlook for the Australian economy, the Queensland property market, and we'll include some time for your questions on the Please use the Q&A function down the bottom of the page in Zoom to ask any burning questions throughout the webinar, and we'll get back to these at the end of the session. We'll also be recording the session today and sharing with registered participants, and there'll be a small survey at the end where we really appreciate your feedback in order to improve future webinars. Mark and Gareth really are two of the most popular people at any party, in my view. Who doesn't want to know about property or the economy? So I'll hand over to them to further those conversations. Gareth, I think you're up first.
Thanks, Donna. I'll just bring up my slides. Oops. Right. Thank you all for dialing in today. As discussed, I've got about 20 minutes. So I think what I'd mainly just want to do is run you through kind of the high level views of the economy and sort of how things have progressed since we last spoke around 6 months ago, and where we think we might be sort of heading from here. So for me, I think, try to do things in a theme-based way, but really, I think the big four things right now for this year, looking forward as an economist, are really what happens to global growth, interest rates and inflation. I don't think that would surprise anybody. We've had some big policy responses to both the pandemic and now the inflation outbreak that we've seen since. Geopolitical risks are also elevated and provide us with the growing risks or new risks, even as we put most of the pandemic effects in the rearview mirror. For Australia, I think the big sort of themes are much the same in that, inflation has moderated quite significantly, but, what we're really watching from here is how do we do, how does that last little bit of moderation go as we return back to the RBA's target, and how long does that take? And also, I think a really big one for most businesses and the economy more broadly is really, we think we're at the low point in growth. So we think there'll be a bit of a slow start to 2024 in terms of growth. But importantly, we expect growth to rebound in the second half this year, and we'll talk about why. And lastly, I'll leave much of the property detail to Mark today, but at a macro level, the supply-demand imbalance is important to us. It impacts quite a few of these aspects, including both inflation and growth. And so I think we'll touch on that at a high level and leave the detail on prices, rents, and other property market metrics to Mark. But just starting with the big picture, as I said, it's reasonably encouraging at a high level. You can see that inflation has eased quite significantly now. across most advanced economies. We've had a few data points since we last spoke around 6 months ago. You can see that it's come well off those peaks of 8, 9, 10%. Currently around 3 to 4 in most countries. Consequently, you can see on the right that we think rates are kind of near their peak, are at their peak across most countries at this point. And you can see that they've basically been flat for some period now. It's just a question of how long are they held at that level, and when do central banks start to cut against that inflation backdrop, rather than any increases. The good news is that, alongside this rapid increase in rates to near decade highs or more than decade highs, and the moderation in inflation, growth has certainly slowed, but we haven't seen any major downturns as yet. And labour markets across the advanced economies have held up relatively well. So, quite a period of slow growth over last year, and we expect it to remain below trend but positive this year. And obviously, unemployment has drifted up a little bit, but it's certainly still at very low levels. So to date, a relatively, orderly adjustment, let's say, to higher rates and to bringing inflation back. But the big question and the big focus going forward is really what does it take to kind of get back to targets sort of sustainably across those countries. And something that's been quite topical over the last week is really what's happening in the US, for example, where growth has actually remained quite resilient. The unemployment rate fell last month, and we've seen inflation accelerate over the last 3 months. So the ride might be a little bit bumpy. We closely watch, but for now, we're optimistic that rates are at their peak for this cycle. I guess turning to the local economy, much of the same story. So growth in Australia certainly slowed quite sharply over 2023. You can see there that the red bars, which is household consumption, is quite important. It's around 60% of our GDP. And you can see that for almost 3 quarters, it's been pretty flat. We expect a fairly soft quarter this quarter, but we do expect that to start picking up in the second half of this year and seeing growth return closer to trend. Just a note on the other component there, which has been quite important, despite that slowing in private sector consumption. Key supports to growth really have been government spending, particularly on infrastructure, parts of business investment, and also the recovery in trade. Offsets or maybe some downsides to that have really been what's happening in housing construction, a bit of a drag on activity, and those parts of business investment that might be a little bit more mixed as pandemic-related policies such as the instant asset write-off are kind of wound back. But obviously, for now, relatively treaded relatively okay through those challenges of higher rates. So how have we tracked into 2024? So obviously that data on consumption and national accounts is lagged. It's the end of Q4 2023. You can see here that business conditions, which is our monthly business survey, where we go out and we ask businesses every month, what are your employment levels, your trading conditions, and your profitability doing? And we summarize them as business conditions. You can see here that certainly they declined, quite a bit over 2023. But of note is that they're actually still well above their average, right? So, even as growth slowed, businesses are still telling us that capacity utilization is quite high. Business conditions are above average. CapEx expectations are actually above average, and so are employment expectations. And so despite that very sharp adjustment going on in some sectors in the economy, the aggregate picture has been relatively resilient. A key dynamic we talked about last time were simply the pressures on household incomes and households more broadly, and the impact that then has on consumption decisions. You can see here, looking at the black line, which is real disposable income, so income after the impact of interest, tax, and after accounting for the purchasing power of incomes, had declined quite sharply. So, fell in year-ended terms for around 5 to 6 quarters. It actually turned in Q4 last year, so picked up to being positive and flat over the year. So kind of a little bit more data than what we had last time. We can see here that we're probably past the peak of pressures on household budgets now. But to reiterate, you can see just how significant and how strong the impact of price rises were, or inflation was, on reducing purchasing power. You can see there that obviously interest payable, which is the purple bars, widened as rates rose. And also quite topical at the moment is the income tax story, which, with some nominal wage growth, the increasing importance or drag from bracket creep with the tax burden, now around 20% of gross income. Again, just highlighting because it will come up later, but the grey bars at the top have been kind of a key support. So labour income has been quite solid, driven by, a rise in hours worked, still positive employment growth, and higher nominal wage growth. Has been a key kind of offsetting support from those very big drags on the household sector. I think going forward, we're watching quite closely, but really we think that interest rates are at their peak for now. They'll start to be cut later in the year. That will reduce the drag from interest payable. Inflation is expected to continue to moderate and actually has done a little bit since the end of last year. And so that impact on spending power will reduce. And then lastly, we'll obviously get the tax cuts around the middle of the year, and that will be a support as well. So really a key dynamic for what's going on in household consumption still. And part of the reason we think that spending will pick up a little bit more notably in the second half of the year. Just turning to how consumers have kind of adjusted to these high rates and other pressures. You can see here the Consumer Stress Index from our NAB quarterly consumer survey kind of reflects the breadth and the significance of the pressures faced by households over the last year. So these are all higher than over a year ago. You can see there that the unemployed, renters, younger people and lower income peoples continue to be the most significant impacted by the pressures on household budgets, but maybe a little bit of good news coming out of this survey in Q1. So for the first time in around six quarters, consumer stress actually ticked down. Cost of living remains the biggest source of stress for consumers and households, though it ticked down a little bit as well. That said, 1 in 3 still report high levels of cost of living stress, and is quite correlated with the categories we mentioned before. So how have households adjusted? Maybe this is a little bit more of a relatable chart, but in aggregate, when we look at our big national accounts measures, we've certainly seen a decline in discretionary spending over the past year. Goods spending is down a little bit, but essentials have kind of tracked broadly sideways. Putting it into our survey terms, you can kind of see here that the big categories where households really are pulling back or adjusting or trying to cut back in addressing other cost of living pressures is really the discretionary factors. So eating out, micro treats like coffees and snacks, certainly entertainment, and even with petrol prices where they are looking to pull back on car journeys. On the flip side, if you kind of look on the right-hand side in the bottom panel of that graph, you can see that the least impacted, or the areas that households are less likely or less willing to cut back on, have really been kind of some essentials, things like private school fees or school fees, children's activities, spending on pets, home services, and even insurance. So kind of that adjustment still going on. And I guess the flip side again of that really is in aggregate, what has happened. So sure, households have kind of made an adjustment. They've pulled back on spending. In per capita terms, actually spending has fallen. But we can also see that households have chosen to kind of save a little bit. So the adjustment on both sides of the equation there. Gross savings actually ticked up a little in Q4 last year. So we think this is broadly leveled out, and it is still positive. So households aren't, in aggregate going backwards entirely. So moving on from kind of the consumer, the other really big dynamic that we're looking at, and I'll leave Mark to comment on more of the detail and more of the trends here, but is to really say that, house prices have continued to rise at a relatively solid pace. They've slowed in some cities, but, over the year, still tracking at around 10% year on year. That's quite strong and something that, was or has been a bit surprising given the very strong increase in rates, reduction in borrowing power, and challenges to housing affordability. Indeed, rents growth is still very strong, and vacancy rates are quite low across the country. So quite an important dynamic for house prices. What's really going on there? We talked about this a little bit last time, but actually we've got some more detail here as well, and the picture is becoming quite clear. So over the year to September, Australia-wide population growth of 2.8%, its strongest rate since the late 2000s. That's around 600,000 new people and about 550,000 new migrants, which entered the country over that year. You can see here that for Queensland, it's quite stark. So certainly a very strong rebound in the black bars, which are overseas migration, around 80 or 90,000 migrants over that year. On top of that, Queensland continues to benefit quite strongly from interstate migration flows, and that's seen your overall population growth rate reach very high levels, right? So over 3% in civilian working age terms. Obviously adding to kind of the pressures on the demand side for housing there. Much of the trends on the supply side have continued over the last 6 months. You can see there that dwelling completions, so new supply of houses, have tracked broadly sideways at around 170,000 a year. It is quite high in a sense, but it's certainly well off the peaks we saw between the 2015 to 2020 period. And you can see down the bottom there, Queensland currently a run rate of around 34,000 dwellings per year, and quite a bit lower than where it was also in that 2015 to 2020 period. The pipeline, though, is quite high, so it has started to ease a little bit Australia-wide and in Queensland, but remains relatively elevated. So a bit of a question we're thinking through and kind of working towards is what is the challenge here, right? Demand is quite strong. The pipeline is quite large, but completions seem to be tracking a little bit lower than they should be. And we know that new approvals are quite weak. So one of the big things that we think is playing out at the moment really is that construction cost. We know supply chains have kind of normalized, at least to some degree. But what we also know is the actual costs of inputs into housing construction haven't really normalized. So inflation has certainly slowed. After peaking at about 17% annually, the price rises in housing construction costs are around 5% still, which is relatively strong and will be a challenge for inflation. But I think really the top part of that left-hand graph is what we're getting at here, where despite that easing in inflation, construction input costs are still around 30% above where they were. Certainly this comes through our residential construction survey, which you can see on the right-hand side. The share of respondents telling us that, what the main barriers are to new developments is certainly coming through in the construction costs, with around 3/4 of respondents pointing to that as an issue. We can see labor availability actually eased a little, but is still pretty significant. And then obviously delays in planning permits and obtaining planning permits is the challenge. So despite that strong growth, a fair challenge on the supply side still kind of playing out in the housing market. What does that mean from a very big picture view? Well, housing affordability is quite weak or quite low. You can see here that the PropTrack housing affordability measure, which measures the share or the proportion of sales on realestate.com.au over the last year using 25% of gross income of the median household, has fallen to its lowest level in around 30 years. So that figure's just 13%, which is quite stark. Australia-wide, you can see there that Queensland is certainly deteriorated, but actually marginally more affordable than the Australia average as a whole. I guess shifting focus slightly now on the labour market. So despite that slowing in growth, labour markets, like many of the advanced economies, have certainly held up. So across the states, unemployment is still quite low. It's certainly ticked up a little bit from very low levels in most areas, but is kind of well below where it was pre-pandemic. And, quite interestingly, despite that slowing in growth and the fact that employment across Australia is now around 1.3 million people higher than it was pre-pandemic. Vacancy rates and forward-looking indicators are actually still quite positive, right? And you can see that the labour market is still a little bit tight, despite that slowing in growth. And really where that's coming through is the strength in wage growth that we've seen. So across the country, it has picked up on our best measure, which is the wage price index, which is wages per hour. Wage growth peaking at around 4.2% now. You can see that it's accelerated across almost all industries compared to pre-pandemic, but really it's strongest in health, education, training, also the sectors that kind of benefited or saw the largest minimum and award wage increases last year. So wage growth certainly coming through, as I said before, and supporting household income, offsetting some of those pressures, but becoming, I guess, an increasing focus in where we go for inflation. So like the globe, we've certainly eased from our peak, quite obviously from around 8%. We're down tracking at about 3%, 3.4% on our monthly indicator. A little bit above the RBA's target, and I guess a square focus now on how and what does it take to get inflation back from just above that target to something closer to the middle, and how long does that take? The story to date really has been one of, kind of an unwind of those global factors that we saw. So firstly, the more trade exposed items in the inflation basket, so typically goods, we've seen some falls in a couple of categories. We've also seen quite a bit of disinflation across a few of those, and you can see that prices or inflation for those goods / trade exposed things certainly have eased as, freight costs, transport costs, and global prices have kind of eased. Home building, which was a big contributor on the way up for inflation, has also eased, but it does remain high. And then I think the thing we're really focusing on here is what is the domestic pressure? And these things are typically, made up of services where there's a larger sort of labor component, and probably, what we consider a little bit more domestically focused. So, the questions here are, as those global factors wane, where does inflation end up? And I think the focus in that sense is why everybody is looking so strongly at the services side, which has eased a little bit less. Interestingly, what we do know about the services side is, certainly wage costs and wage pressures are an important component of that. We also know other things such as other overheads, such as insurance, utilities, energy prices, even commercial rents, have certainly all added to those pressures. So it's not just wages we're focused on, and there can be a few ways that services prices continue to ease. And we think that lots of those previous factors, so the energy costs, the utilities, kind of reflect lagging factors and will continue to ease. And then it's just a matter of, is wage growth kind of consistent with inflation tracking at target? And so, as I said, with wage growth at its peak, we do expect it to kind of ease from here. We think the RBA will see inflation kind of land back within the target, maybe around the end of 2025 or into kind of early 2026. And so what does that mean for interest rates? Well, I think like the globe, where we've by all means, I think, likely peaked. The question really is how long do we keep the brakes on? How long do rates stay up at that 4.35%? And how quickly does the RBA cut from there? We think by the end of the year, really, they'll have enough confidence that inflation is coming back towards the middle of the target band within kind of a reasonable time. And they'll be able to gradually kind of start reducing that restrictiveness of policy, cutting back to around 3% over the year from November or so. So how do we think this all plays out? Well, as I said, we think we're near kind of the low point in growth. There is a bit of an adjustment going on, but we have reasons to believe kind of the second half of this year is where we really start to see a bit of a turnaround and a bit of a pickup in growth. So we'll see around 1.7% this year, which is below trend, but probably something closer to 2.25%, 2.5% next year, which is closer to trend. That below trend growth does see unemployment rise a little. So currently around the high threes. We expect that to kind of gradually drift up with employment growth, still positive, but unable to absorb just that sheer strength in population growth. And eventually the unemployment rate will reach something around 4.5%, which is certainly higher than it was around a year ago, but kind of well below or a little bit below where it was pre-pandemic. On inflation, just to kind of round out, we think pressures will continue to ease. We think it could be a little bit bumpy. It has been globally, but general continuation of the trends we've seen. And so we'll end up at about 3% by the end of this year, and kind of the top end or the top half of the RBA's target band by the end of 2025. So I might leave it there and hand over to Mark for some more detail on the Queensland property market.
Hey, thanks, Gareth, and great to join you all again this afternoon and share some property insights for Queensland. Just to give you a sense of today, I'll be sharing the residential components, both metro and regional, and then also make sure I share some insights on commercial and also for rent rolls as well. Since we were last here, the value of Australian housing has continued to increase. This slide gives you the representation of all the store of Australians' wealth here, and just from a housing sense, up another $0.2 trillion since our last update about 6 months ago. So just showing you the contribution of residential property in particular, and Queensland's been a key driver of that. So let's unpack that in a bit more detail, given the new records being set each month as Queensland continues to track north on property prices. This gives you a representation of houses versus units right across the capitals, but particularly highlighted centre of the page there for Brisbane, reflecting houses for the quarter and annual, as well as units, reflecting strong growth in both property types over the course of the last 12 months, and continued strength, particularly in units over the last quarter. More broadly, looking right across the country here, this is for the first quarter ending the end of March, first quarter of 2024. You'll see there price growth in Brisbane up 3%, nationally 1.6%, and in regional Queensland continuing to rise, also up 2.8% for the first quarter of the year. And far right-hand side of the page there, you'll just see the graph of movement of property prices, both regional in grey and in capitals in red, over the last decade, seeing how price movement has occurred, with lots of that decrease actually less being evident in the Queensland market rather than in other locations around the country. I'll give you a sense as to what part of the market is moving. You'll see here the quartiles of the market. So this is the red bar representing the most affordable quartile of the market, which in Brisbane has continued to experience really strong growth, up 4.6% over the first quarter of 2024. The more expensive quartile of the market, which is the black bar, growing at 2%. So there's your contrast between the price segments of the market across Brisbane. If we go now to some of the sales activity, so this is modelled sales activity, recognising that final sale doesn't occur until the settlement actually occurs, and there is a little bit of distortion between what's modelled here in Brisbane versus the actual, which I'll be able to unpack for you at a location by location basis in a couple of moments' time. You'll see here modelled sales are up 4.4% for the 12 months compared to the 12 months prior, reflecting continued activity here. Right-hand side of the page picks up the national 6-monthly moving average, just to give you a sense as to smoothing out some of that volatility of the monthly result into the red line, which reflects that 6-monthly average. So moving away from modelled sales till the end of March, I want to just give you an update across Brisbane. So Brisbane is currently at a new peak level, up another 1.1% in March, 3% for the quarter, up 15.9% on this time last year, and up an amazing 55.2% on March 2020, which is 4 years ago now, when before the onset of the pandemic. Who remembers that? But anyway, property prices have certainly been on a rocket over that period of time. Listings, you know better than most. The challenge to get listings either for your business, if you're in the real estate profession, or for consumers looking for properties to purchase or even to rent, it's been a really significant challenge. And this just reflects that continued challenge in the Brisbane market. Listings down just under 10% on March last year. And as I said, actual sales now are down 2.9% till January versus the prior period. So this is sales that have gone through that settlement period and recognising the end of period. So modelled sales were a little bit higher, actual sales a little bit lower, which we'll unpack on a region by region basis shortly. Reflecting the intensity of people looking to buy, you'll see days on market remaining really tight. In fact, has got tighter than this time last year, notwithstanding the increase in interest rates that has occurred over the last 12 months. Other factors, including migration, including the appeal and relative affordability of the Brisbane property market, has seen continued demand, and average days on market 22 days versus 26 at this time last year. And it's not just properties to buy that's been hotly sought after. Properties to rent has also been a firm area of appeal, with house growth in house rents on 12 months ago up 7.6% and 11.2% for units, reflecting continued strong growth, very low levels of vacancy, and again, significant competition for any available property in most instances in most markets, not only in Brisbane but right across the regions as well. What I thought it might be helpful to do is to see this visually. The bluer areas are the rates of the locations where there's a higher rate of growth occurring, and you'll see the pockets of Brisbane where that's evident. Likewise, there's a couple of small pockets there that are a little bit more orange in nature, which reflect softer conditions in those locations. Just a visual to try and bring that to life. If you would prefer a more tabular format, here's the SA4 regions across Brisbane. This reflects each of the locations, both monthly and quarterly insights there, and showing strong rates of growth for the quarter in Ipswich and Logan, and really reflects that strength of also the lower price points in the earlier segment-based insights for Brisbane as well. So on rental growth over the last 12 months, it's inner city Brisbane and the north, Brisbane North, which is up 18.2% and 13.2% respectively. So strong growth in rents. Average selling days, Moreton Bay South at 15 days is the shortest. Interestingly, the north at 25 days is the longer element occurring as an interesting contrast there. And compared to the sales for the 12-month prior, inner city up 11.5% and Brisbane North up 2.9%, reflecting some of the Brisbane on a page insights at a more granular level. Just to bring that sales information to light, you'll see sales are, this is settled sales now, reflecting 2.9% lower than 12 months ago, only 1.7% lower than the 5-year average, notwithstanding well off their peak period a couple of years ago. Listings to March, reflecting the challenge to get available listings and to meet the demand that is there. Listings are softer, just under 10% than 12 months ago, and running lower than the 5-year average by 6.6%. And on the left-hand side, you'll see that settled sales information spread through the key geographies of Brisbane as well. Give you a sense in the regions now, and we've given similar information here at a regional level, tabular format, key SA4 regions and key locations in the table there with quarterly growth information available. And you'll see there that Townsville and then Gold Coast and Rocky are the key top 3 locations that are showing the most value growth over the quarter. For rental growth the last 12 months, it's the Darling Downs, Toowoomba, and that lead the pack there at 18.9%. On selling conditions, activity there, Toowoomba selling quickest at 19 days, and Mount Isa, which is part of the Outback SA4 region in Queensland, is taking the longest, up to 80 days on average in that location. Then sales activity for the regions, Sunny Coast off 3.1, and Townsville down 9.6, really reflecting what has been change conditions as see and treat change has started to normalise in lots of the regional parts of Queensland, more back to longer term averages as opposed to off beyond that more broadly. This gives you that larger sense of the regional location, regional parts of Queensland and sales activity, sales volume activity occurring in those locations. On commercial, just to give you a snapshot on commercial, more broadly speaking, with the rapid rate of interest rates, it's only normal for yields in commercial properties to start to decompress or normalise back to more historic and longer term averages. That said, there's a couple of other subsector or asset type locations and factors also going on. For industrial, we're seeing strong demand for industrial historically over the last couple of years. Vacancy rates are starting to creep back up to normalised levels. They reached historic lows, less than 1%. A little bit more activity happening in completions in Brisbane and the key industrial precincts of Brisbane, and certainly from a leasing activity and purchase activity, a little bit of moderation that's occurred in the last quarter in that space. But notwithstanding, there's really 2 markets continuing to emerge. Top end, which is very much investment focused and has benefited from the rise in rents, but offsetting that is the decompression or the easing of yields versus the market where owner-occupiers are starting to control their own destiny and step in and make purchases of industrial properties themselves. They've seen rents rise 20, 30 more % over the last couple of years, and they don't want to be subjected to that environment and want to take control of that. So really a divergence happening in the 2 aspects of industrial. In retail, we're seeing retail continue to adjust through its phase. The retail market was perhaps more advanced even when COVID occurred. It had started to reset, and as a result, it's probably the first to start to emerge with some more normalised level of activity of sales. Lease confidence is also starting to emerge, and we're seeing face rent growth and up across a number of capital cities, including Brisbane, in retail, in the retail space as well, and starting to see an increase in sales activities in the retail space as well. In office, a little bit of a different theme in office. We've got obviously a flight to quality occurring right across the globe in office as tenants seek to move to higher graded office, better fit out, better accommodation and facilities end of trip at cafes and the like, higher ESG rated properties, Green Star rated properties, NAB's rating increase for energy efficiencies and the like. And more broadly, tenants looking at their space requirements given what is emerged as a hybrid environment of work from home for some days and space required in the office for other days, and repurposing of what office is providing. So that is a macro trend that is still working its way through. There is some sales evidence occurring for some prime buildings, but still relatively modest compared to other asset classes. Secondary office is going through its biggest adjustment and yet to see the full extent of what that adjustment will mean. Secondary office has higher vacancy rates typically and is also considering working through whether owners will retrofit that, convert it to another type of purpose, and how that will reset. And so it's still got some time yet to flow through to that to get the full sales evidence and to be able to track how that's looking overall before that settles. So retail probably most advanced on its reset, industrial next, and office still some time to go before we start to see the end of and the adjustment of that phase. Moving on from the snapshot for commercial to give you a snapshot for rent rolls. And many of you running property and real estate businesses will be interested in this slide. This just tries to give you on a page how things are tracking from what we're seeing from transactions and valuations in market currently. It is certainly true to say that rent rolls have definitely benefited from the rise in rents that we've been talking about earlier. We've seen the level of investment to retain some of the property management staff over recent times, and to increasingly have them manage arrears and manage through property transitions in that space. More broadly, though, there's still staff turnover, challenges attracting new staff, and we've still got a number of changes occurring in the environment, including the residential transactions, the tenancy and other incentives that government is looking to require or provide in the market more broadly. So just a range of different factors going on, and just to give you that overall snapshot on a page, I trust is of interest. Perhaps with that, Donna, I'll hand back to you to facilitate any questions that have come through from our webinar today.
Mark, and that, as always, is fantastic, and you certainly provided us with some great insights to digest today. Again, reminder, Q&A, please put any questions that you might have in there, and I will be ready to read them out. But as always, I have a couple from myself for you both. Gareth, one for you, that you put up some numbers there with respect to migration, and a lot of us in Queensland are, we know it's a great place to live, so we're very conscious of the effect of migration here. 147,000 migrants, interstate migrants, 33,000 houses being built. I'm not sure what the average math is. How far under are we if we're under? So if I divide it by 4, is that a reasonable effect of persons in any one accommodation? Is there such a thing?
There is. That's a good question. You've got me on the spot. I don't know Queensland offhand, but I can tell you nationally, which won't be too different, is the average household size is about 2.6 people.
Right.
So obviously you
Right.
don't have 0.6 of a person walking around, but I think it's an interesting point, right? Like in that kind of analysis, we're looking at Australia-wide a shortage of, let's say, 60,000 households a year right now. And that's a challenge, right? One thing that kind of got revealed through the pandemic is, as economists, we think about preferences and revealed preferences, and you can see that, as soon as prices sort of eased just even a little bit, the household size really fell, right? So yes, there was a bit of demand for space, like kind of talking about on the commercial side, but really what it is, housing is quite expensive, and this is kind of pressuring it. So even if we kind of build enough to catch up, it's a big question on how we sort of deal with that kind of underlying shortage. As you say, Queensland is probably the standout for sure in terms of migration. There's a few different trends going on across the state. Some have benefited from interstate migration where they don't normally, others have lost out, but it's kind of correcting. But for now, Queensland, and WA is just outright the strongest. So it's interesting. It's a challenge. It speaks to the need for kind of infrastructure, but also, as I'm sure Mark would say, very much how do we deal with the supply side, which you can't just turn around, in 6, 12, 18 months even.
Yeah, and look, so like I'm just doing the maths on my calculator beside me. So all I can say is there's a big differential, and no matter if we use 2.6 or anything else. But so then we overlay that into, the demand of trying to build infrastructure for the Olympics in this city. And then the net effect potentially on rents. There's a lot that's going to continue from what I can see with respect to pressure, both, on the local economy and with respect to access to rent, and then potentially the rents rising. Do you still see that as being an outcome?
Yeah, I think that's right. Like we said, the demand has been quite strong. Population growth, nationally will sort of slow, kind of. We've now recovered that level of students. We've recovered the level of the population we would have had without having lockdown. So we do expect it to kind of slow over the next, sort of, let's say, year and a half. The challenge is Australia is always a fast growing place. So, we're slowing to 1.5 instead of 2.8 where we are now. And that's actually, one of the fastest growth rates in the world. So kind of those pressures are still there. I think it speaks really to the need or the importance of kind of the role of government at the moment, right? So I think, Queensland's got to deal with that kind of infrastructure and the Olympics, but, housing will be an increasing challenge as it sort of is everywhere, and how we navigate that will be kind of, important for the cost of living, for productivity growth, and for just affordability, in an outright sense.
Yeah, and so it sounds to me like Queensland, even if migration for Australia decreases, Queensland might be at the back end of seeing any of the real benefits of that.
Yeah, I think that's right.
Where it comes to pressure on the internal systems.
That's right. As you say, it's quite a fast growing place. It's also got the largest interstate migration, I think. So, for now, that demand or that strength looks like it will persist for quite a while.
Quite a while. And then we've got, again, I mentioned to you that I was going to talk about the Olympics. We've got in Queensland, it honestly feels like everybody's holding their breath, because we potentially will have 3 elections, right? We've already had the council, we've got the state, potentially a federal, I think. And yet we've got to be planning infrastructure for the Olympics at the same time. What could possibly go wrong?
$1 million question. I think one thing is costs, which is, I know that's got a fair bit of attention already, and that's probably a wise thing to be considering. I think the experience on these things is that costs do end up costing a whole lot more, and then we kind of question what is the benefit. So, I think it's really thinking about those costs kind of quite deeply, but also hopefully using the infrastructure that benefits more than just, specifically the Olympics, but kind of can benefit the Southeast and Queensland more broadly, I guess, in the longer run as well.
That's great. And Mark, do you have a view on anything with respect to the Olympics and the pressure that Queensland's seeing at the minute?
Look, aside from the remarks Gareth's made, I think the need for trades to help with the infrastructure build, to help with the housing that is needed is not only a challenge for the country, but a particular challenge given the clear timeline. You can't run over on delivery of some of that infrastructure, and we do know how long it takes to get infrastructure out of the ground, get it completed. We know how much it clogs up the M1, which always seems to be under construction every time I'm on it. I don't think it's personal to me. And that's only just one little component. There's heaps more that needs to be done. And as you say, definitely a long-term need to not only build for the games, but also to build for the underlying growth that's moving to Queensland as well. So there's kind of two horizons: one, the games infrastructure, but two, just to provide sufficient infrastructure for the migration is also a key requirement as well, Donna.
Yeah, absolutely. We do have a couple of questions coming from our viewers. So one, I think, is for you, Gareth. How do you see the international events impacting, such as the Israeli conflict and the Chinese property company, as in Evergrande, going into administration?
Yeah, good question. Like I said, we've the pandemic impacts are sort of, fading into the rearview mirror, but more things keep popping up, right? That list just keeps getting longer of risks. I think we've navigated fairly well to date. I think, tackling China first, obviously, there are some adjustments going on in the property sector. The risk for us is obviously on trade. Our biggest export is iron ore, and obviously they're our biggest consumer. So, what happens there is important. I guess, interestingly, what's happened, recently, prices for iron ore have fallen a little bit, but actually are still very high. So, despite those challenges with Evergrande and the property sector, which have been going for a little while now, the volumes and the prices have actually been quite okay. So it's kind of watching what happens going forward. The Middle East is another challenge, I guess. It's a little bit more distant and a little bit less of a direct trade impact, but certainly, comes through things like oil prices, shipping costs, freight. We don't have huge direct trade with them, but it can impact, global capacity. And we did see freight costs again spike, and we've all seen what that can do to goods prices. Interestingly, they've kind of unwound a little, so there's a bit of an adaptation going on, but we'd have to see how that really progresses. So, as the pandemic fades, we kind of keep getting these new risks from a few different angles, and hopefully we kind of navigate them okay. I think lots of our issues or our challenge this year is also kind of domestic. So, hopefully the globe kind of gets through it, but we kind of face into our domestic challenges as well.
Yeah. Do you think, and this is, I don't want to make light of Evergrande and the Israeli conflict, but the recent changes with respect to wine exports, is that going to help somewhat?
Yeah, it's interesting. It's good. We've gone out of a world pre-pandemic where maybe there was a bit of trade, what do we call it? Trade wars, trade restrictions, kind of building the sentiment between the US and China. It is good news. I think we've kind of seen an easing, not just on wine, but a few other of our key commodities. And I think that's quite important. But we've also sort of, we've learned a lesson through the pandemic of the impacts of borders closing and being able to trade. And so, the strong sentiment I get from quite a few businesses is that they do try to think a little bit more broadly about diversification and what is their consumer base at this point. So certainly good news for the wine producers in the Barossa and, maybe the lobster producers out of WA for now.
It's true. I know my husband's stocked up just in case we're paying more, that's for sure. Hey, Mark, Faisal's got a question for you. What are the current trends in lease incentives being offered in new commercial leases? This is a really tricky space, I think.
Yeah, look, it is. Incentives are largely more prevalent in the office space, to be real, and in some of the secondary stock. For example, in the pockets with most vacancy, say for example in Docklands in Melbourne, they're over 50%, closer to 60% type incentives. They're not at that type of level in Brisbane or in Queensland more broadly. So largely depends on how the deal's structured, Donna. So it's not one size fits all, but they would be certainly more in the lines of the 30s and 40s kind of longer term numbers still at the moment. The older and the more secondary nature, having to push that a little bit higher than prime new stock, where there is a little bit more competition occurring for available supply. Brisbane's not too badly placed from a supply demand balance, so that's moderating the need for the ambition on incentives. But that aside, there is still some evidence of elevation, particularly for secondary properties.
Thank you. Well, I might take that with no more questions from our guests as a moment to wrap up. And thank you both for joining us today and giving us your insights. Thank you as well to our customers and guests who have joined us and taken the time to participate. We'll be sharing the recording of the webinar on our business review and our insights page. And as this brings us to a close, we look forward to seeing you all again in the near future. Thanks again for your time and have a great day.
Thank you.